In this video, we talk about why over 40% of Americans retire with a mortgage, and most of them think they're doing the right thing. Are they correct? We'll talk about that next on Holy Schmidt.
Holy Schmidt!
If you ask most people whether they should retire with a mortgage or not, the vast majority of those people would say no, absolutely not. Yet, over 40% of retirees 65 and older have a mortgage, and more than 30% of 80-year-olds have a mortgage. 30 years ago, that number was just 24%. So this isn't a handful of stragglers. It's 4 out of 10. So why do they do it? Well, reason number one, it's just pure math. They have a 3% mortgage, and they don't want to give up a 3% mortgage. They bought a refinance when mortgage rates were at the low point, and they're convinced, as well as a lot of other people, I might add, that we won't see rates like that again in our lifetime. They say when your rate is 3% in a safe investment like a CD or treasury bonds or higher than that, you're making money, and you're losing money by giving up the mortgage. Here's how they see it. Say you have $100,000 in safe savings earning 4%. That's $4,000 a year. The same $100,000 used to wipe out a 3% mortgage saves you $3,000 a year in interest. You just gave up $1,000 a year to feel debt-free. Now, what we're talking about here, by the way, isn't a small balance. The median balance for an older homeowner is $110,000. The Harvard JCHS even points it out. They note that carrying the mortgage can be a reasonable choice, a way to keep more money invested and more cash on hand for other needs. And none of this means that debt is good, by the way. What it does mean is that a fixed, cheap loan isn't the emergency that a lot of people think it is. Reason number two is something that people forget about until they need it. That's liquidity. That's just a fancy word for how fast can you turn something into cash. When you pour your money into paying off your home loan, the money doesn't disappear. It just changes form. It turns into home equity, and home equity is hard to spend. You can't hand the grocery store checkout clerk a brick from your wall to pay for this week's groceries. To get to the equity, you either need to sell the house or borrow against the house. Reverse mortgages may make some sense under certain circumstances, but those are quite limited, and you never see me talking about those here on the channel. The median older homeowner has about $250,000 in home equity. That's a lot of wealth, but it's wealth you have to live inside of, so you can't easily use it to cover a new roof, a medical bill, or a few rough months in the market. Picture two retirees with the same exact net worth. One paid off the house and has very little in the bank. The other has a mortgage, but has a healthy cushion in the bank. When the surprise emergency bill shows up, and it usually does, the second homeowner sleeps better at night. House rich and cash poor is a real trap. And using funds that are earmarked for something else to pay down your mortgage is a quick way into that trap. Gang, if you're still using spreadsheets to manage your finances, you're doing it the old-fashioned way. And the biggest problem of all is that spreadsheets can make mistakes, and they're hard to work with under multiple scenarios. If you have one formula in the wrong cell, all of a sudden everything is wrong in many cases. With Bolden, you can manage a lot of different what-if scenarios, like should I pay off my mortgage or should I keep it? What happens if the markets go up, if they go down, if they stay the same, etc., etc. If you'd like to try it for free, you can use our affiliate URL. Go to go.bolden.com/Schmidt, and you get 2 weeks free of their full-featured software. After that, it's just $12 a month paid annually if you'd like to keep it. Number 3 is where the math gets interesting and where a lot of advice goes wrong. And this is the pay off the mortgage versus invest the money math. The classic argument goes like this. Don't pay off the house, invest the money instead, because the stock market earns 8% and your mortgage only costs 3%. In my opinion, that is not an honest way to look at it, because the market can go up and it can go down, which means you can't spend the 8% per year. And this is particularly true in a bad year. A much more fair comparison is your mortgage against something that's safe, like a CD or treasury bills. If your loan is 6.5%, which is today's going rate, by the way, plus or minus a little bit, then paying it off quickly makes a lot more sense. And just to be really clear, paying off your mortgage doesn't make your house free. People still have to pay for maintenance, repairs, taxes. They still have to pay for the utility bill and a whole host of other costs. And home insurance, by the way, is up 57% since 2019. On a $400,000 home, property taxes and upkeep can easily run $8,000 a year or more. And then you have people on the other end who say, why don't you just sell the whole thing, take the $400,000 or whatever the pile is, and invest it? Well, let's examine this. Let's say you sell a $400,000 home and it costs you about 7%, nearly $30,000 in selling costs. You put what's left in a safe municipal bond paying 4% tax-free. That provides about $15,000 a year. Then you go rent a similar home, which in much of the country runs about $24,000 a year or more, $2,000 a month. The rent eats all of that income and more, and your home is gone and any future appreciation is gone. Which means that for many retirees, selling to rent means that they're going to come up behind. So the real question isn't debt versus no debt. It's what does my money earn if I keep it versus what do I save if I spend it, and the housing costs that never go away sitting on both sides. For some people, paying it off wins. A lot of it's peace of mind, but there are other aspects as well. For others, keeping a low interest rate loan outstanding is the winning play for them. The point is to run your own numbers and not rely on a slogan you heard somewhere. Now let's talk about the mortgage tax break, because this is something people cite when talking about keeping a mortgage outstanding. First, let me say that there are some good reasons to keep a mortgage outstanding, but for a retiree, the mortgage tax break probably isn't one of them, at least the average retiree. Here's why. To deduct your mortgage, you have to itemize your deductions. And you only itemize when your deductions are greater than the standard deduction. In 2026, the standard deduction for a married couple filing jointly is $32,200. If you're 65 or older, you get more on top of that. Each person gets $1,650. And through 2028, if you're 65 or older, you get another $6,000 per person. When you add all of that up, a married couple over 65 can start off with well over $35,000 in deductions. To beat that by itemizing, your mortgage interest would have to clear the whole bar. On a typical older mortgage with, say, $100,000 left in the balance, the interest just isn't there. So most retirees take the standard deduction and they get to the same spot without using the home mortgage interest deduction. There is one wrinkle worth mentioning. The cap on deducting state and local taxes rose to about $40,000 in 2025 through 2029, which pushes a few more people into itemizing. But even then, for most retirees, the math just doesn't work. So the tax reason for keeping a mortgage usually isn't real for most people, but sometimes the first three reasons are. Gang, how prepared are you for retirement really? A lot of people think they're more prepared than they really are. One of the ways to check is to take my free retirement readiness quiz. It's 15 questions. It takes 2 minutes. No credit card, no phone number, nothing like that. It's totally free. Simply go to hollyschmidt.com/quiz, fill out the 15 questions, and a 12-page report with your information, your results, will be emailed to you instantly. You'll also get put on our list and get tips, tricks, and other information a few times a week. Reason number 5 is one that the housing market created almost by accident. I call it stuck-in-place economics. Picture a couple that would happily downsize. They have a balance on their house, they're paying 3%, but they would sell the house and have a smaller mortgage. Unfortunately, that mortgage is 6.5%. In that scenario, their payment could actually go up even though their mortgage balance would go down. On top of that, selling isn't free. Between closing costs and getting the house ready to sell, these costs run about 6 to 7% in a lot of cases. On a $400,000 home, that's $25,000 gone before you even move. So they do the math and decide to stay put, and staying put means keeping the mortgage they already have. They're not in love with the loan, they just can't find a move that makes financial sense right now. And by the way, you're seeing this all around the country right now. Existing home sales have hit a 30-year low. People who have a mortgage don't want to give up a 3% mortgage. If this is you, the takeaway is simple. Don't feel behind for keeping the mortgage. In today's market, staying put with a cheap loan is often the rational choice, not a failure to plan. And reason number 6 is one that I personally feel is the most compelling, and it has nothing to do with money. For a lot of people, the house is almost a member of the family. It's where you raised your kids, where your family pet lived, where decades of holidays happened. If you've ever driven through an older town, and we have a lot of these in the New York area, the Connecticut area, some houses actually have names. Now, I'm a CPA, and I think in terms of dollars and cents for a living, but even I'll tell you that some of the memories inside a home are worth a lot more than the numbers on a spreadsheet. So people keep the home and the mortgage that comes with it because giving it up means that you're giving up something you can't get back. That is a completely valid reason as long as you do it with your eyes open and you understand the interplay between that decision and your finances. But here's an honest follow-up question, because this happens a lot. Let's say you keep the home. Will you be in that home 20 years from now, comfortably? Will you be able to get up the stairs? Is it the right size, or are you heating a bunch of empty rooms? And by the way, this matters more than people think. Less than 4% of homes in this country have the features needed for aging in place. Less than 4%. I'm talking about a single floor living, a no-step entry, wide doors, shower bars. So the home you love today may need some changes to love it in the future. If you like this video, check out that video. Here's where retirees spend almost all of their money. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt to get your 2 weeks free. After that, it's $12 a month paid annually. This is Jeff Schmidt, and I will see you in that video right there.